Hello students. In class 11, you have already studied microeconomics. Now, in class 12, we are learning macroeconomics. So let's understand the difference between microeconomics and macroeconomics in a very simple way. This is also an important question for your exam. So let's start with the concept. Microeconomics studies economic problems at the individual level. It focuses on one consumer, one household, one firm, or one industry. For example, imagine a family has a monthly income of rupees 30,000. So here the family has to decide how much money should be spent on food, how much on education, how much on entertainment, how much should be saved. So these decisions are made by one family. So this comes under microeconomics. Now let's look at macroeconomics. Macroeconomics studies the economy as a whole. Instead of focusing on one family or one company, it studies the entire country's economy. For example, how much is India's national income? What is the unemployment rate in India? Is India's economy growing? So these all are topics of macroeconomics. Now let's move to the second difference, which is the central issue. In microeconomics, the main issue is allocation of resources. Resources like money, land, labor, and time are limited. So people have to decide how to use them wisely. So if you see according to the consumer point of view, for example, suppose a consumer have only rupees 500. So with that 500, he can buy a textbook, a t-shirt, or a movie ticket. But 500 is not enough to buy everything. So the consumer have to choose how to spend his money to get maximum satisfaction. This is what microeconomics studies. According to producer's point of view, for example, let's think about a bakery owner. He has limited flour, sugar, and workers. He has to decide whether to produce more cakes or more biscuits to earn maximum profit. This is also a part of microeconomics. In macroeconomics, the main issue is not one person's decision. Instead, it focuses on the overall level of output, employment, and economic growth in the country. For example, suppose unemployment in India is increasing, the government may start new industries, improve roads, or encourage businesses to create more jobs. These decisions help increase employment and economic growth. This is what macroeconomics studies. So the major goal of macroeconomics is growth with stability. There should be no inflation or no deflation. Now let's look at the third difference, economic variables. First, let's understand what an economic variable is. An economic variable is simply something whose value can change. For example, demand, supply, income, and prices can increase or decrease. So, we call them economic variables. In microeconomics, we study individual demand and individual supply. For example, suppose you go to a supermarket to buy chocolates. The number of chocolates you want to buy is called consumer's demand. Now think about the shopkeeper. The number of chocolates the shopkeeper is ready to sell is called producer's supply. Since we are talking about one consumer and one producer, so this comes under microeconomics. Now, in macroeconomics, we don't study one consumer or one producer. Instead, we study aggregate demand and aggregate supply. Don't worry about the word aggregate. So, aggregate simply means total. So, Aggregate demand means the total demand for all goods and services in the entire economy. Similarly, aggregate supply means the total supply of all goods and services produced in the entire economy. For example, suppose we want to know how many mobile phones one consumer wants to buy. That is microeconomics. But if we want to know the total demand for all goods and services in India, that is macroeconomics. Now, let's move to the fourth difference, aggregation of economic units. This may look like a difficult term, but it is actually very simple. Aggregation means combining many small units into one larger group. In microeconomics, the level of aggregation is limited. That means it studies only a small group. Suppose we are studying the mobile phone industry, we include all mobile phones companies like Samsung, Vivo, Oppo, Apple, etc. Although there are many companies, they all belong to one industry. So, this is still microeconomics. In macroeconomics, the level of aggregation is much wider. Instead of studying only one industry, it studies all industries together. It studies agriculture, manufacturing, banking, transport, IT, education, healthcare, everything in the economy. Example, if we study the textile industry, it is microeconomics. But if we study all industries in India together, it becomes macroeconomics. Now, let's look at the fifth difference, economic agents. First of all, what is an economic agent? An economic agent is any person or institution that takes economic decisions. Now, let's see the difference. In microeconomics, decisions are taken by individual economic agents like consumers and producers. For example, suppose you want to buy a new mobile phone, you compare different brands and finally choose one. This decision is taken by you, that means the consumer. Similarly, a shopkeeper decides how many mobiles to keep in his shop and at what price to sell them. These are individual decisions, so they come under microeconomics. The main aim here is personal benefit. A consumer wants maximum satisfaction and a producer wants maximum profit. In macroeconomics, decisions are taken by institutions instead of individuals. Some examples are RBI. RBI controls money supply and interest rate. SEBI. It regulates the stock market. So these institutions make decisions for the benefit of the entire economy, not for one person. Their aim is economic growth with stability. For example, if inflation is increasing, the RBI may increase the interest rate to control inflation. This decision affects the whole country, so it comes under macroeconomics. Now, let's move to the sixth difference, method of study. Don't worry about the terms partial equilibrium and general equilibrium. They are actually very simple. Microeconomics studies only one market or one product at a time. Suppose we are studying only the market for milk. We study only the demand and supply of milk. We ignore what is happening in the markets for rice, vegetables, or petrol. Since we are studying only one part of the economy, it is called partial equilibrium analysis. Next, macroeconomics. It studies the whole economy together. It considers all markets, all industries, consumers, producers, and the government. Example, if petrol price increase, transport cost will also increase. Then the prices of vegetables, milk, and many other goods may also increase. Macroeconomics studies this overall effects on the economy. That is why it is called general equilibrium analysis. Now, let's look at the seventh difference, assumptions of study. This point may look difficult, but let's simplify it. While studying one consumer or one firm, microeconomics assume that the country's total output and total employment remain constant. It does not focus on national income or total employment. Suppose we are studying the demand for ice cream. We don't worry about how many people are employed in India or what the country's total production is. We assume those things remain unchanged. In macroeconomics, we focus on national income, employment, inflation, and economic growth. Here, the distribution of income among individuals is assumed to be constant, while the main focus is on the overall economy. Example, suppose the government wants to increase employment, it studies the country's total production, total income, and unemployment levels. This is the concern of macroeconomics. Students, now let's learn an interesting concept called the micro-macro paradox. So first, what does the word paradox mean? A paradox means a situation where something that looks correct in one case may become incorrect in another case. In simple words, what is good for one person may not be good for the whole economy or whole country. This is called the micro-macro paradox. Let's understand it with a very simple example. Saving at the micro level. Suppose I am a student or an employee. Every month I save 2000 from my salary. Because I save money regularly, after 1 year I have a good amount of savings. This money can help me during emergencies or help me achieve my future goals. So, for an individual, saving is a good habit. That is why we say saving is a virtue at the micro level. A virtue means a good thing or a good habit. Next, savings at the macro level. Now let's think about the whole country. Suppose every person in India decides, from today I will stop spending money and only save. What will happen? People will stop buying clothes. They will stop going to restaurants. They will stop buying mobiles and other products. As a result, shops will have fewer customers, factories will receive fewer orders, production will decrease. So when production decreases, company need fewer workers. So employment opportunities also decreases. If people lost jobs, their income falls. Finally, the country's economy slows down. So, what was good for one person becomes harmful when everyone does the same thing. That is why we say saving is a vice at the macro level. Here, vice means something that creates problems for the economy. Now, we will discuss about a simple example. Imagine our classroom has 40 students. If one student saves 100 rupees every week, it is a good habit. But imagine all 40 students stop buying anything from the school canteen. The canteen owner will earn less money. If this continues, the canteen owner may reduce staff or even close the canteen. So, what was good for one student becomes a problem when everyone does it together. This is exactly the idea behind the micro-macro paradox. Students, now let's understand another important concept called micro-macro interdependence. The word interdependence means depending on each other. So, microeconomics and macroeconomics are not completely separate. They are connected to each other. In simple words, what happens at the micro level can affect the macro level. And what happens at the macro level can also affect the micro level. Let's understand this with examples. Macro impacts micro. First, let's see how macroeconomics affects microeconomics. Macro means decisions taken for the whole economy. For example, the Reserve Bank of India decides to increase the interest rate. This is a macroeconomic decision because it affects the whole country. Now, what happens? commercial banks also increase their loan interest rates. Because loans become expensive, many businessmen may decide not to borrow money to start a new business or expand their factory. So, one decision taken at the national level affects an individual producer. This shows that macroeconomics affects microeconomics. Next, microeconomics impacts macroeconomics. Now let's see the opposite. Sometimes individual decisions can affect the entire economy. For example, suppose many people start buying electric vehicles. This is an individual decision. But if lakhs of people make the same decision, electric vehicle production increases. New factories are opened. More workers are employed. The country's production and employment increase. Now, it has become a macroeconomic effect. So, many small individual decisions together can influence the whole economy. Now, let's learn about another important concept called macroeconomic variables. First of all, what is a variable? A variable is something whose value keep changing. For example, prices change, income changes, employment changes. So, these are called economic variables. Now, what are macroeconomic variables? Macroeconomic variables are those variables that are studied for the entire economy, not for one person or one company. In other words, they help us understand how the country's economy is performing. Now, let's see the important macroeconomic variables. First one, level of employment. This tells us how many people in the country have jobs. If more people have jobs, it means employment is high. If many people don't have jobs, unemployment is high. For example, if many companies hire workers, employment increases. Second one, aggregate demand. You have already learned that aggregate means total. So, aggregate demand means the total demand for all goods and services in the country. For example, if people buy food, clothes, mobiles, cars, and many other products, all these demands together are called aggregate demand. And third one, consumption expenditure. This simply means the total amount of money people spend on goods and services. For example, families spend money on food, electricity, education, transport, and medical expenses. All these expenses together are called consumption expenditure. And fourth one, national income. National income means the total income earned by all the people in a country during 1 year. It tells us whether the country's economy is growing or not. Fifth one, aggregate supply. Aggregate supply means the total quantity of goods and services produced in the economy. For example, all the foods, clothes, vehicles, medicines, and other products produced in India together are called aggregate supply. And sixth one, investment expenditure. Investment expenditure means the total money spent on creating new assets or expanding businesses. For example, if a company builds a new factory or buys new machines, it is called investment expenditure. This helps increase production and creates more employment.